Well, good morning, everybody. Thank you for coming to the launch of the Global Risk 2010 report. My name is Richard Elliott. I'm from the World Economic Forum, from the media team. I'd like to start by just saying thank you to MMC and Marsh for hosting the event. It's a pretty straightforward process we have this morning. We'll have 3 or 4 minutes from each speakers, and then there'll be plenty of time for you to ask your questions. So the speakers are this morning Mr. Robert Greenhill, MD and Chief Business Officer at the World Economic Forum, my colleague. Daniel Hoffman, Group Chief Economist, Zurich Financial Services. Raj Singh, Chief Risk Officer, Swiss Re. And John Drzik, CEO, Oliver Wyman, which is an MMC operating company. So without further ado, I will hand over the microphone to Robert, who will give us put the report into context. Thanks, Robert.
Well, thank you, Richard, and good morning, everyone. Thank you very much for being here. Just before we start, I would just like to note that our hearts and hope go out to the people of Haiti and its government that's working to deal with yet another disaster after the hurricane of 2008 and the food crisis of the year before. It's a courageous people dealing with great challenges and great risks. And I think we all just wanted to note our concern for them. And the Forum will be doing what it can to help with that situation and also to help build back better once the immediate crisis is over. In a sense, it's a tragic but unfortunately appropriate backdrop to the issues we're going to be discussing today. And I would like to note and thank our great partners for the collaborative approach that we've taken to help identify the issues. In fact, one of the points we'll be making is collaboration is one of the keys to resolving many of the issues. But to even identify them, the collaboration we've had with the Citi, with Marsh & McLennan, with Swiss Re, with the Wharton School Risk Center, and with Zurich Financial Services has been exemplary and has just gotten stronger over the last 5 years. What we have before you today is, in a sense, a milestone document. It's the 5th anniversary document. It's a concept which came out in 2004. Out of conversations at Davos where there were all sorts of discussions about risk. But it became apparent that these risks could not be analyzed and discussed in isolation from one another. The interconnectedness of them was an increasingly important implication of this increasingly globalized economy that we're dealing with. And therefore, the idea of having an integrated approach to understanding and discussing risk was what led to this report. It's actually had a great track record. If you look back over the last 5 years, this report never predicts risks. What it does is identify key areas of risk. But in fact, of those areas of risk, if you look at the top 6 over the last several years, 3 of them at least, the fuel crisis, the food crisis, and the financial crisis, because of the asset bubbles, were ones that have been identified 1, 2, 3 years in advance of their actual occurrence. And what is interesting coming out of this is that the major challenges today tend not to be risks that are unidentified, they tend to be risks that are unaddressed. And in fact, it's not the sharp risk that occurs that's a crisis like a swine flu, which everybody rallies around to try to address. It's actually the creeping risks that can be put off that become the galloping crises of tomorrow. And we'll see that with a number of the key items that are laid out and will be discussed by my colleagues in more detail in a moment. Issues such as the challenge of the fiscal burden and debt burden as countries go from, in the West, from about 80% debt to GDP to 118%, which is a level of increase unparalleled in peacetime economies. Every quarter a decision can be put off, but the cumulative effect over years could be dramatic and irreversible. Same thing with the burden of chronic diseases, the diabetes, the Alzheimer's, the obesities, the other issues of diseases that aren't able to be addressed, but actually tacked tax our health systems year after year. They can always be put off, but if they're put off for too long, you may have a health system that's overburdened and cannot respond to a critical crisis when it arrives. Similarly, with a third area of infrastructure, which my colleagues will talk about more in detail. This report also notes three areas which have been identified not as top of mind of the key risk analysts that were behind this, but as issues that we believe are going to become of increasing importance and deserve perhaps more attention in the future. The issue of transnational crime and corruption and its corrosive effect on both social and political systems, as well as tremendous economic costs. The issue of biodiversity and the questions of cyber vulnerability, because so much of what we do is now dependent upon an internet and communication system which we take for granted, but which after all is a human institution, and we've never had a human system that hasn't failed. And yet, if this fails, the implications are massive. So, when we look at these issues, what do we say is the bottom line? We're not saying there's any new risks coming out in this report. What we are saying is the risks are more interdependent than ever. Some of them are more serious than in the past. But most importantly, the context is one of increased vulnerability. Because of the challenges of this financial crisis, families, companies, and governments have spent much of their treasure. They've used much of their reserves. Therefore, the ability of families, corporations, and governments to withstand another shock of the size that we've had in the last 18 months is very constrained. What does that mean? It means that these creeping risks need to be addressed proactively before they become the galloping crises. It means also in a time of fiscal constraint that governments are unable to either address or afford addressing these risks in isolation. It will require a proactive approach by all the different members of society to go from identification of risks to addressing these risks in the future. And in a sense, that's the nature of the World Economic Forum. Our very nature is to try to bring people together, to bring stakeholders together from governments, from private sector, from civil society, to figure out how do we improve the state of the world. One of the ways we do this is by trying to identify and address some of the risks that you'll see before us. That'll be a big part of the conversation in Davos. But at this point, in terms of understanding how these kind of risks with their complex interconnectedness can be understood and addressed, I'd like to now turn it over to my colleagues to go into detail on some of the key findings, starting with Daniel Hoffman, the Group Chief Economist for Zurich Financial Services. Thank you very much.
Good morning. It's my pleasure to walk you through the economic risks, and I will do so as I did last year on a risk barometer in a traffic light representation. It's easy to understand. Red means high risk alert, yellow means medium risk, green means low risk. And as you can see, we do not expect any relief in 2010. There are no more green risks. All risks are either on yellow or on red. And for the third year in a row, we find now the risks of a hard landing in China, fiscal crisis, and the risk of a collapse in asset prices on, if you will, high red alert. Let me take each of these three risks in turn. First, the asset price collapse. Some may be surprised. Didn't asset prices already decline quite substantially? And didn't we see a reasonable, if you will, return to seemingly health in the banking sector? Well, the old asset bubble of 2008 is gone indeed. But there are new bubbles. If you look at China, large cities like Shanghai and Beijing have seen house price increases more than 60% in 2009 alone. If you look at some of the international capital flows, Nouriel Roubini talked about the mother of all carry trades being implemented right now. More generally, you see a lot of search for yield, almost in disregard or in denial of risks. It's as if the crisis of 2008, 2009 had never occurred. Clearly, What we're seeing right now going on in the world of finance is a lot of liquidity swapping around that's being created in an effort to fight the crisis, and it looks as if this crisis fighting has made us more vulnerable for future risks down the road. The only thing that's changed, if you will, is the composition of the asset bubble. Second, the hard landing in China. In fact, this is a risk that we've been warning of for 5 times in a row now. Is this the dog that never barked? Well, don't forget, risk assessment does not mean prediction about the future. However, I would like to underscore that China is on a very unbalanced growth trajectory right now. If you look at the fiscal stimulus, it was 14% of GDP, about triple the size of the fiscal stimulus administered in the United States, and that was already considered a very large stimulus. If you look at monetary stimulus, the result was a credit expansion of more than 30% in China in a year alone. These type of developments typically lead to inflation. Right now, we see consumer price inflation in China of roughly 4%. That doesn't sound alarming. However, 3-4 months ago, we still saw negative inflation rates in China. And food price inflation, typically the leading edge of inflation anywhere in developing countries, was 20% in China already by the time of November. Clearly, we're in an environment where policy mistakes can be made, and the risk equally of a hard landing in China is equally high then. Final fiscal crisis. We're not talking about the exploding budget deficits in the wake of the current crisis. They typically decline as quickly as they arose. What we're talking about are the underlying trends, and we give you some numbers in the report. And we make a particular reference to the so-called generational accounting. That means we're talking about implementing and accounting for promises that the government gives to future generations in terms of Social Security, in terms of healthcare benefits, etc. And when you do that calculation for the United States has a budget generational deficit of roughly 600% of GDP. That's not just the 100% of GDP that the governments are heading to. We need to face, if you will, the realities. Government debt levels of 100% of GDP and higher, and this is where the US and the UK are heading to over the next couple of years, are clearly not sustainable. There's an inherent risk that the investors may take fright, that all of a sudden they may question the sustainability of these debt levels. The result is, if we will, sovereign debt crisis and defaults. Clearly, Dubai and Greece were early warnings. They should be heeded. Secondly, research tells us that once government debt to GDP levels are higher than 90%, there will be a continuous drag on growth, roughly a magnitude of about 1%. So growth will be slower because debt levels are simply too burdensome. Clearly, there's a vicious cycle between low growth and high and unsustainable debt levels. Clearly, something needs to be done to address these topics. The 3 risks I just talked about illustrate what Robert alluded to, that risks are interconnected. You cannot analyze it in isolation. They're interdependent, and they must be tackled jointly. It underscores, it's another risk that we address in the report, the global governance gap. I would say that at this point, the jury is still out whether our politicians are up to the challenge. So far, I've only talked about the jumbo jet level analysis of global risks as far as the economic sphere is concerned. Let me quickly break this down to the individual country levels. What I do here is an analysis based on our proprietary Zurich's Global Risk Assessment module, where we look at these risks in the context of 160 countries. On the vertical axis, you see asset bubble risk displayed. On the horizontal axis, you see all other risks displayed. And as you move from the southeastern corner of the map to the northeastern corner of the map, the risks increase. The lower section of the map, that's a bit difficult to see. You see a lot of blue dots. Those are the African countries. There are no real assets to speak of in African countries, therefore no asset bubble risk. The only risk that these African countries have to deal with are economic risks. The exception is South Africa, which you find a blue dot at the very top of the map. South Africa has assets to be concerned about. Consequently, there's also the risk of an asset bubble collapsing in South Africa. South Africa shares a lot of similarities with, if you will, the Western countries in Europe and the United States. They're all located in the upper part, in the upper segment of the map. Finally, look at this striking cluster over here in the northeast. That's China, and it's China's neighbor in Southeast Asia. Clearly, these countries are exposed both to economic risks and to asset bubble risks. In that sense, the results from our modeling align with the results from the Global Risk Report that we just heard. There is no decoupling, and there is no all-clear signal for these countries concerned. And with that, I would like to hand over to Raj Singh, who will talk to you about infrastructure risk.
Thank you very much, Daniel. I think I'd like to move on to one of the parts of the report which really struck me with when I looked at the large numbers. We talked about the reports, a lot of interconnectivity, and also competing fiscal deficits and things like that are going on right now. But where will we get the money for some of these creeping things that Robert was referring to? So when you look at it, the World Bank estimates that 35 trillion is required over the next 20 years just to sustain existing infrastructure in the what we call the developing countries, and also build sustainable levels of infrastructure in the developing countries. So for me, this is a huge sum of money. It's going to be a lot of competition for the dollars. How do we get this organized? And also thinking about this just the United States, and when you go into the report, you'll see some of the numbers there. The United States itself, on an annual basis for the next 5 years, has to spend something like a couple trillion a year in terms of bringing up the infrastructure to what they would consider to be an A standard infrastructure. So I mean, so it's both an issue for the developing world. It's of course an issue for the OECD world as well. But also these new frameworks that are being established. New frameworks need to be established to encourage private-public partnerships, more institutional money to come into these areas, because it cannot just be the government spending right now with the way the fiscal deficits are going. So I think that's one thing. But infrastructure investments are key at any time, but how will we really get the right balance of where the money can go? Because the areas for infrastructure are normal things that we think of. It's also the infrastructure like airports, just roads, but also it's things like agriculture. Like agriculture, have we spent any money since the 80s or 90s in agriculture? Not a lot's been spent. We're talking about water there. Do we really have sufficient water to really feed the population? So I think those are the kind of issues that we have to look at. Just moving on, I'd like to spend a bit more time on agriculture because the infrastructure is rather well known to everybody. But what's the real issue with agriculture? And we're thinking a bit more long-term here. We're expecting an increase in the population in our world to about 9.1 billion in 2050. That requires a 70% increase in food production. And if you think of this 80s, 90s, and the 2000s, there's not been a lot of investment at all in the agricultural sector. So how are we going to feed that population? So this is one of those creeping risks that is coming upon us. And so for us, this is, again, a very, very important area to look at. In terms of you look at the volatility of commodity prices and what really happens with it, it doesn't normally lend itself to proper capital flows to go into this area. So I think what we really have to look at public-private partnerships and interests on parts of the governments to bring capital in. And just an example of that is recently something that has been done with the Beijing municipal government, where they're trying to cover natural catastrophe risks for their farmers on the agriculture side. But the idea of bringing risk transfer in is also to flow private capital in to support what they need to do on the agriculture side. So I think that's very important. I think private-public partnerships will be key. In terms of just the last piece, we talk a lot about the key risks in our report, but also we're also talking a bit about how should we really look at this from a risk management perspective. So when you get deeper into the report, you'll see a section where we've introduced the Economics of Climate Adaptation study, which is done by a working group that's associated with us. And what you'll see there is that we're trying to also come up with prioritization tools, because how do you prioritize where government should spend money or where private sector should spend money money in terms of climate adaptation, which is something that I talked about last year, and I was concerned about last year whether we would have the right investments flowing into this. But with all these competing things, I think this is an area that needs to be looked at, because climate adaptation needs to be spent now. I think the last point I'd like to make on this slide, because I'll leave the numbers for you to read, but the idea is that there are tools and mechanisms we also are trying to help to provide in order to come up with this proper prioritization. The last point is on country risk officers and country risk management. If we look at what's happened across the world in the last few years, and the Global Risk Report has been pointing out since 2007 that we need to look at something like a country risk officer, or somebody that's looking at the interconnectivity of the risks and the risk landscape of the individual countries, understanding the interconnectivities, work more on a multilateral basis. So it's something we've still been having in our report each year, and this is again the third year of mentioning that in there. So I'd like to leave you with the thought that we also need some oversight over the general risk landscape and the interconnectivity of risks in the countries. Thank you. I'd like to turn over to John Drzyk.
Thanks, Raj, and good morning, everybody. I'm going to focus my remarks on an example which illustrates a key theme of this year's report, which is the interdependence of risks. And you'll see in the report this year there's a number of risk interconnections, maps that focus on different risks. I'm going to focus on one example which puts at the center of the map oil price spikes as a key risk and connects them to other risks. And I've used here a simplified map. The ones in the report have all of the risks covered in the report this year. Here I've just picked out one example and wanted to kind of draw some connections for you. So, and I think oil price spikes are one of the more interconnected risks amongst the risks that we cover in the report. You can see on the left a couple of things that can amplify the risk of an energy security issue and an oil price spike, which are geopolitical events, and then also another key element of this year's report, underinvestment in infrastructure. With respect to energy infrastructure, over the past year, the IEA estimates that there's been a 19% reduction in investment in new oil and gas projects and a 20% reduction in the investment in renewables, which would have been even higher, somewhat on the order of 30% without government stimulus packages, which filled some of those gaps. But that underinvestment in energy infrastructure is obviously contributing to the potential for an energy supply shortage and therefore another oil price spike. On the other side of this, you have, well, what would happen if you had amplified risk of an oil price spike because of this underinvestment in infrastructure? Well, that could itself expand the risks that Daniel and Raj were talking about. Could expand the risk of a fiscal crisis as you have increased pressure on economies that are already troubled by increasing debt burdens, and then could also increase the risk of food price volatility and therefore food security because energy is a key cost in that equation in transportation and other parts of what builds up in a food price. So there's an interdependence, obviously, between oil prices as well as all of these other risks and factors. So now let's think about, well, let's say we're going to try to solve this problem and try to reduce the risk of oil price volatility by improving energy security. So let's take a current example looking at biofuels. So you're just illustrating what I talked about. Now, biofuels policy, and so take, for example, the U.S. policy to try to increase, as part of its renewable energy program, biofuels by about a factor of 4 over the next 10 to 15 years as a new source of energy and increase stability of energy security. Well, biofuels are based on, many biofuels say, based on corn, sugar, other crops. And if you start using those to solve the energy security problem, obviously one of the things that can happen is you've now increased the food security problem because you've now started to deploy some of the scarce resources in arable land toward one problem of energy security. You may be now increasing the food security problem. Or alternatively, if you start to cut down rainforests in Brazil to increase the amount of arable land, you now hit another risk. risk, an environmental problem. So you may be solving energy security, maybe staying neutral on food security. You've now amplified another risk. So I think one of the things I wanted to highlight with this example is that there needs to be more cross-departmental coordination within governments in order to solve these problems, which is another key theme of the report around governance gaps. Obviously, it's energy, agriculture, transportation. There's a lot of departments that have a stake in prioritizing projects of this type because you could be pushing down one risk while increasing another simultaneously. So more coordination across departments within governments, also more coordination across different governments. I mean, if you think about the two problems, energy security and food security, which one is more important? Well, it's different prioritization in different countries, given their state of development and the relative impact of a rise in food prices versus energy prices. So it's not going to be easy to solve these issues because of the requirement for new forms of cooperation across departments, across countries, and so forth. And I think it's one of the key themes of this year's report is to highlight those governance gaps in the public sector, and also part of the way to solve these is with public-private sector cooperation on things like investment in infrastructure, and that too will require new forms of incentives and new ways of going about solving these issues in order to prioritize what are the most important projects for the public sector to undertake or to undertake in cooperation with the private sector. So with that, let me hand back over to Robert to open the Q&A session, or to Richard, sorry.
Cheers, thanks, Tom. Right, thank you very much. We've got plenty of time for questions, so if you can just say where you're from and wait for the microphone. Thanks a lot.
And who you want to address the question to.
Yeah, and if it's for a specific person, please say. The microphone is at the back, I believe. Or it's just arriving. Here we are.
David Banks from Global Reinsurance Magazine. This is a question mainly for Raj, because he mentioned about risk officers, country risk officers, and I was wondering whether that was an appointment that needs to be done on a government level, whether that was what he was referring to.
Yes, we strongly believe that should be the case. We just call it country risk officer. It means really having a proper official or proper department that's looking at the interconnectivity of risks. There are elements of it already in place in some governments, but mostly terrorism-related or emergency-related. But we think it needs to be broadened in terms of scope to look at the risks across the whole realm and look at the risk landscapes. We have done some work with the OECD, and we're looking to do some more work, and there is some resonance, but we need a stronger buy-in for that.
Okay, another question at the back there, gentlemen.
From Al Jazeera English. Mr. Greenhill, apologies, I was a little late, and I understand you have given your condolences to the people of Haiti, but I wondered in a broader sense, what your report would have to say, or what bearing it might have on the catastrophe there and the implications of perhaps the progress towards recovery, and whether or not any of your conclusions might point towards perhaps in future better arrangements, or some way in which, when these tragedies, natural tragedies, strike, they are coped with in a better way perhaps.
Yeah, thank you. Well, two things on it. I think, first of all, it was really just a statement of condolences to the people of Haiti in this difficult time. I think the tragedies in Haiti, not only today but in the past years, underline the terrible implications of sustained vulnerability or fragility. The fact that Haiti had such reduction of its forest cover meant that the hurricane in 2008 hurt it more. The fact that it has not been able to invest in adequate infrastructure has meant that the disasters hurt the people more gravely because of the substandard quality of many of the buildings, but it's also actually made it more difficult to have search and rescue operations work effectively, because much of the country's infrastructure, indeed tragically, including the UN's, has been affected. In terms of the issue of responding, there actually is a disaster relief network that the Forum helped set up after the tragedy in Gujarat a few years ago. And I know many of our members are going to be engaged in both individually and collectively what they can be doing to help the people of Haiti.
If I may, there's a concrete proposal in the report. One of the tragedies is when disaster strikes developing countries is that the effort to reconstruct the economy far exceeds the local ability and the local financial means. So the question is, can they rely on development aid be funneled into these countries very quickly? Typically no, because development aid is tied to very concrete projects and programs that need to be worked up prior. Would there be fast disaster relief available through insurance programs? Yes. You could actually administer that. You could actually cooperate, and some insurance companies and some also reinsurance companies have drawn up projects like that. Raj is probably better equipped to talk about that. But the idea is basically that you shift that risk of a catastrophe hitting one of those developing countries to the capital markets through insurance schemes. You issue a catastrophe bond, if you will, that then allows you fast dispersing money once a disaster has struck, and provides relief to the governments whose fiscal abilities to actually provide for reconstruction is limited. And we make that proposal in the report.
Okay, lady just here.
Peter Apps, political risk correspondent at Reuters. It strikes me a lot of the risks you've identified here, be it the fiscal crisis, be it the ongoing, the rising toll of chronic diseases, stem from an aging population. Even the world's growing population is a problem, not so much people being born as people not dying, and to a lesser extent people like me surviving horrific injuries and then lasting quite a long time. How can democratic governments address that when they're on a 5-year electoral timescale? How can you address these kind of generational risks without simply losing the next election through giving too much bad news?
Let me answer that with examples, which is it can be done by being aware of the issue and bringing the future into the present. And that's what reports like this help to do. It's by helping making decision makers and the general population aware of the importance of acting now for issues in the future. I come from Canada. One of the things that the government did during a very challenging fiscal situation over the last 10 years is reform its pension plan system to ensure that it was in fact viable, unlike a number of other national countries around the world, or national governments around the world. So it can be done, but it does require a explicit discussion and debate between all the different stakeholders for governments to be in a position to do that. And I think we're actually seeing both the challenge as well as the opportunity of that around the whole climate change debate, which has moved much further in the last 3 or 4 years than one could have imagined, say, in 2005. Although, to your point, it's not clear yet that there's been enough determination to resolve the issue now. But that's a huge challenge for us. I think what this report says, though, is we cannot afford to wait, because the cost of letting these creeping risks become galloping crises is simply unsustainable for us, particularly coming out of this last set of crises.
And another point, in the report we make the point that when it comes to the fiscal position, emerging market countries as a whole look much better than most advanced economies. When you had taken the same analysis 15, let's say, or 20 years ago during the Latin American debt crisis, the picture would have been completely reversed. In those days, it was typically, if you will, your Latin American debtor country that was overextended in both private sector and public sector debt. They have gone through serious adjustment programs. They have really put their fiscal houses in order. And just to remind you, I think it was a cover story in The Economist last week that also contrasted that and told us how well emerging market economies have been doing during that particular crisis, how much more resilient they were because they had put their fiscal houses in order. Yes, it can be done, and if you do it, you reap immediate rewards.
I could just add one point and just agree with the premise of the question, which is that our time horizon in risk in general is too short. That is a point I was making last year at the same forum, which is, and it has various consequences, but as you're highlighting in the political sphere, because the electoral cycle is much shorter than the cycle at which these risks play out, which can be 10 to 20 years, it creates problems in the public sector. There's equal problems in the private sector with focusing on too short a time horizon, and the underinvestment in infrastructure problem in the public sector, I think, is mirrored to some large extent in the private sector as well. And I think that this is a major issue, and I think a major issue highlighted in this year's report with that horizon in mind is the underinvestment in various forms of infrastructure, whether water, energy, road, rail, and so forth, and that we have structurally deficient infrastructure already, and we need to make those investments now, but it's really hard to do it because we're at a state where there aren't the resources to do that, which is going to increase all these risks in a creeping way over the next 5 to 10 years.
Okay, just here, gentleman there, his hand up just there.
Could I ask you to elaborate on the asset bubble dangers? You mentioned some housing bubble, I think, in Beijing or Shanghai. I mean, are we talking about local bubbles? Are we talking about a worldwide asset bubble crisis again? What kind of bubbles are we talking about?
Well, it's very tempting to try to refight the last war. Clearly, an asset bubble that we've seen just happening and bursting probably is not going to occur again in the next decade or so. But we see the results of, if you will, very aggressive monetary policies being played out in the markets right now. We're seeing traders and banks and whatnot borrowing at very low cost and again exercising sometimes highly leveraged bets again, and I mentioned the carry trade out of the dollar in high-yielding currencies. And clearly, those are accidents waiting to happen. And you may also remember that over the last weekend, the BIS called some of the world's top bankers to Basel to discuss precisely this. We're taking, again, new risks in the area of banking without really commensurately putting up capital for those things. And it is as if, though, we've been talking a lot of financial sector reform, these reforms have not even been seriously tackled yet.
I'd also add that in markets where you have seen a residential real estate bubble burst, there's still, in some of these, the potential for commercial real estate to play out as another asset bubble that could have an effect on the banking system.
Okay. Next question, please. Gentleman there. Yeah.
Hi. Hi. Paul Davis from the FT. As returning to the population issue, I actually wanted to ask a similar question in a slightly different way. I mean, do you all agree, do you all think that this kind of Malthusian idea of population expansion is the main driver of, excuse me, of a lot of these risks? And if so, is there any way that that particular driver can be tackled, do you think? I mean, China, obviously, with its single-child policy, was never particularly, it was seen as somewhat barbaric, and has also caused a problem for an aging population for them. So, I mean, is it something that can actually be tackled? And is it the risk that is driving these other risks?
Let me answer that and say it's certainly not the only driver. But population growth is a major driver in two ways. One is if you believe that there's limited resources, including a limited ability, for example, for the atmosphere to absorb CO2, if you divide what can be produced or emitted by 9 billion instead of by 6 billion, it actually means there's a limit at a time when expectations of the population in terms of their lifestyle and consumptions are continuing to increase. And for the 5 billion out of the 6.5 who don't enjoy anything close to the kind of lifestyles we enjoy, that's very understandable. So that's just a simply mathematical challenge. There are, in fact, though, acute, so that's a kind of a chronic element. There's there's the acute element of population growth in fragile states with fragile or deteriorating ecosystems. If you look at Niger, which under environmental, in terms of ecological balance, is considered one of the most challenged countries in the world. At the same time, it has one of the highest population growth rates in the world, so its population is expected to triple over the next 40 years, even though it's actually had famine in 1 out of 3 or 4 years for the last decade. You put that mathematics together and you say that's a real challenge. Afghanistan's population is expected to increase by 30% over the next 10 years. Pakistan's population is expected to expand by 40 million over the next 10 or 15 years, which is about the same size of Pakistan's population at independence in 49. So you have the general area, but you also have this acute issue in fragile states. There are a lot of very positive voluntary approaches to dealing with population growth that have to do with education of girls, has to do with access to contraception. In fact, many of the models have turned out to be much more effective than the Chinese model, as well as much more appropriate. In fact, one of our Global Agenda Councils looking at population growth as part of our looking at different risks has identified this as an opportunity. So I don't think it's either a Malthusian situation, and it's certainly not a draconian solution. It's more a thoughtful 21st century viewpoint on this issue that this report helps raise. It is just, by the way, though, from a development, one of the challenges is many of these risks people ignore because it doesn't fit into their mindset. This has been an issue and a risk that has been ignored by development practitioners and many others for the past couple of decades. So it's one we're likely to see more of in the future.
Lady at the front here. Yes.
Nadia Weeks from ENDS Europe, which is a news service on European environmental policy and legislation. Looking at the barometer section here, the Global Risks Barometer, environmental risks appear to have increased. Nearly all of them, a couple of them are on the same level as previously. However, there's nothing environmental in the top 6, whereas there was one last year on increased risk of resource depletion for land, energy, and water. How would you explain that?
Well, we have to be a little bit careful what we're talking about here. When you look at the risk barometer, we look at each individual risk and we make an assessment whether the likelihood has increased or decreased, and we make an assessment whether the severity of this particular risk has increased. When you look at the risk landscape earlier in the report, we display that in a quadrant, likelihood on one side and severity on the other side. And we then, when you look at each individual point in there, that's in fact something like your expected severity. In other words, that's the likelihood multiplied by the severity. And depending on those numbers, you may get higher, if you will, expected severity values for certain risks than for others. And some of those environmental risks, they don't quite move up that dramatically when you look at the expected severities. However, individually, we may have upped some of the likelihoods and may have upped some of the severities by small factors.
I think just to add there, I think it's really the propensity of allocating funds towards what needs to be done today or yesterday is the issue. So the environmental things are very well known. They've been in the report. But the question is, will funds get allocated with all these demands that are out there?
And I would also add, we're looking at 36 risks here, and by the way we formulate our criteria, that already means those are risks that ought to be on the radar screen. And it doesn't mean that one is actually less important than another.
The gentleman here with glasses.
Hi, this is Mattia Bagnoli for ANSA, the National Italian Press Agency. I just wanted to come back to the notion of generational deficit introduced. And you presented rocketing figures for UK and US as well. And I wanted to know, how did you get to those numbers? And secondly, I was wondering if you if you have assessed the deficit of Italy as well, which notoriously has one of the highest debt rate in the G8 group. And when I said deficit, I mean generational deficit of Italy. Thank you.
Well, we didn't do the numbers ourselves. The intergenerational deficit numbers, or debt numbers, if you will, they come from studies conducted most prominently by a Boston University professor, Larry Kotlikoff. And Kotlikoff and his team, they have done that, again, most prominently for the United States. And that's the number we make a reference to. Now, there are many other economists that have replicated Kotlikoff's work for other countries, and they've come to the conclusion that some of the other European countries, particularly with demography issues, lack of, let's say, immigration, for instance, and so are in a dire predicament as well. Now, you mentioned yourself already Italy, with a notoriously very high debt to GDP ratio, and clearly once you're stuck in that debt to GDP ratio in excess of 100% of GDP, you find yourself in a growth trap. I mentioned already that once these countries exceed the 90% threshold, growth tends to be cut by about 1 percentage point. That simply means that with lower growth, you're playing catch-up game that's almost impossible to win. So you need to address your expenses primarily first and upfront and quite aggressively.
This gentleman here has been waiting. Thank you.
Alexander Campbell from Risk Magazine. A couple of questions. First of all, on the chronic disease issue. You've got some impressive figures here on rising rates of chronic disease, morbidity and mortality in developing countries. To what extent are those just the effect of mortality being unmasked by decline in infectious diseases? I mean, everybody has to die of something. If you're cutting down on infectious disease rates, then you are going to see more people in the country dying of chronic diseases and of accidents, presumably. And the second, more generally, looking at your global risk landscape, could you briefly name which risks have moved most sharply up and right since last year, sort of the fastest rising risks? Thank you.
To tackle anyone chronic?
Chronic, you can go.
Well, okay, I'm taking the chronic disease quickly. Again, this is work, much of that work has been done under the auspices of the World Health Organization. And in one sense, the prevalence of chronic disease is, if you will, the success of development. These people experience higher life expectancies, sometimes due to increased prosperity, sometimes due to better nutritional habits. And currently, right now, you have a rule of thumb that about 2/3 of the population in advanced economies tends to grow older than 70 years. Whereas in developing countries, only about 1/4 of the population exceeds age 50 and higher. And over the next 20 to 30 years, we expect these numbers to change dramatically. We expect life expectancies in developing countries to go up quite dramatically. And with that comes, as you pointed out, the backside of higher life expectancies comes the accumulation of chronic diseases. Some of that chronic diseases comes also because developing countries, unfortunately, acquire the bad habits of the West, i.e. bad nutritional habits. And sometimes bad nutritional habits are also highly correlated with poverty. And again, so it's a nice illustration of the point that we make in the global risk reports. You cannot tackle just one risk in an isolated way. You have to look at the interdependencies between all those risks, and just trying to zero in on life expectancy may get you on the wrong track. You have to really have a broad-based development project underway.
Okay, we'll just take, sorry, did I interrupt anybody? No? Just take one more.
The most changed risk? Well, one of the risks that really moved up in our perception is infrastructure risk, the undercovered infrastructure. We had that on the radar screen for a number of years now, but over the years, and certainly last year, also under the, if you will, the perception of the fiscal crisis now becoming more prevalent. Infrastructure deficits have moved up in our perception.
Can I just make one other point on the chronic disease? Because it's not just a developing, it's also a developed country issue. And it's a great example of how you need to have a proactive and systemic view on the issue. It's actually, instead of having diseases that a doctor or nurse can fix when you get ill, to have, whether it's diabetes or whether it's Alzheimer's or whether it's the implications of obesity, these ongoing issues, requires a very different system. And also, they're great examples of having a proactive and multi-stakeholder approach to actually trying to prevent these issues. Having corporate wellness programs, empowering and educating individuals is actually a massively positive return on investment for governments to be doing, rather than waiting till the diabetes has become chronic and then trying to help deal with that person over the 20, 30, 40 years that they may have this chronic condition. And that's a great example of what we're talking about a preventative, proactive approach to understanding and resolving the issue. And with all these things, whether it's healthcare or infrastructure, clearly governments are not going to be able to handle it alone. It's going to require all the different stakeholders to be involved in trying to deal with these issues.
Okay, we just have one final question. The gentleman who's been waiting there just in the middle. Do you want to keep going?
Patrick Hosking of The Times, and this is probably for Daniel. On the question of a sharp slowdown in the Chinese economy, could you elaborate a bit on how that might play out and why it would necessarily be a bad thing, and could there be benefits to the world in terms of less pressure on commodity prices?
Well, how will it play out? We're not here in that sense to make a forecast, but clearly right now it's here for everyone to see that the Chinese economy is in the process of overheating. The authorities have already announced some moderate tightening on the monetary policy side. They've already also announced some increase in capital requirements from their banks. So this is geared towards, if you will, taking down the speed a little bit of acceleration. Now, we're much concerned about what would happen if China would slow down below, let's say, 6% GDP growth. First, you would have an impact domestically. It would be very difficult to keep the domestic labor force employed. As you know, there's a tremendous internal migration of labor from the rural, if you will, western provinces of China to the fast-growing eastern provinces along the seashore. Now, if growth falls, some people claim if growth drops below 8%, it's already going to be difficult to keep these people employed. So there's a potential for social unrest in China domestically. So that would be the first fallout, if you will, domestically. The second fallout is internationally. And again, there are two factors to consider. The first factor to consider is that over the last 10 years, some of the East Asian countries have redirected their export orientation away from the United States over to the Chinese economy. They've learned the hard way when the dot-com bubble burst that being dependent on exports to the United States can be fatal and can harm your economy. And you can see that in the trade flows. A larger share of exports from the Singapores, Taiwans, Koreas now goes to China than it used before, and less goes to the United States than it used to before. So these countries will be harmed quite substantially. And as you noticed, I had them in my slide on the upper right-hand corner of my country risk assessment for precisely that reason. So it's the trade flows. And thirdly, right now, when you look at, if you will, at macroeconomic imbalances around the whole world, we're in desperate search, if you will, of a buyer of last resort. Now, if China collapses, China cannot assume that role of becoming a buyer of last resort, in other words, of absorbing other exports that need to be created in order to keep the global economy, and particularly to keep the economy in advanced economies afloat. So you have at least 3 different strands of reactions that would make it very harmful if China's economy could slow down.
And just on the question of commodity prices.
Well, that too. I mean, China has become one of the largest commodity importers, certainly from Australia and also from Latin America. And China is one of the largest importers of steel and coal from Australia. And again, that would have a tremendous impact on those export nations. And actually, South America did reasonably well in this particular crisis because its commodity exports to China didn't really decline as much as in previous cycles.
So high commodity prices, not low.
Well, if high commodity prices are reflecting, if you will, the underlying strength of the global economy, yes. If high commodity prices are reflecting bubble-type speculation, as some have suspected has happened in the oil price segment or in the oil segment, in other segments, then that wouldn't be something we would like to see.
Okay, Rach, we've got a few extra minutes, so we can take a couple more questions if you have them. The lady just here.
Hi, I'm Leanne Brinder from Energy Risk. This may be for Mr. Drzyk, but it's quite regional specific. Do you see an increase over this year and maybe over the next few years for Europe's energy security, specifically from Russia? There's obviously been reoccurring spats between certain nations, which obviously affect mostly the gas reserves for Europe and then impacting on the UK as well. Do you see this as a continual risk, or is it on the back burner, or?
Well, I think energy security in general is a big risk, and I think we've highlighted in this report for a couple of years that we haven't made a specific forecast for this coming year, but I would say it is one of the most interdependent risks in the system, connecting to geopolitical events as you're highlighting, but also to other economic risks, and then downstream into food security and other risks which are part of the report this year. And I would say there has been a structural underinvestment in developing new energy capacity, and that has been exacerbated this year because of the economic pressure. So there's been weakened investment in developing new production capacity, weakened investment in renewables, so we're not on the right track to solving the energy security problem. So I would say the risk has been amplified. How it will play out, it could be over the next 5 to 10 years rather than in 2010, but I think it is one that, were it to play out and become a more significant risk through some type of, and for the price to spike, there's a lot of risks now downstream from that are also going to be affected, as we were highlighting, food security being perhaps one of the most important.
Gentleman here.
I'm Roderick Bruce from Argus Media. Another question for John. Looking at oil price spikes, we've seen legislation and policy efforts in the US from the CFTC to implement position limits and various other suggestions to try and keep oil prices lower or control them or reduce speculation. What do you make of those policy attempts, and why aren't other countries following suit?
I think the attempts are to create a more stable and affordable supply of energy, which I think, if you look at the importance of energy security, it's a good idea. I think the only, without commenting on what the policies of all other countries are, I think if you look at this internationally, though, as a risk, one of the issues with energy security is in addressing it that there are trade-offs trade-offs, both in terms of there's allocation of capital resources towards solving the energy security problem versus solving other problems. Then there's allocation of other scarce resources, as I was highlighting with the example of biofuels. So I think the priority of energy security for different countries relative to other problems is different. And so one general comment I'd make with your question is it may be that whether those trade-offs are being balanced by policymakers in each country well is unclear, but I would say even if they were balanced well for an individual country, you wouldn't necessarily get to the same priority for energy security as in terms of investment dollars versus deploying those to reducing other risks.
Okay, thank you very much. Just to round off, Robert, could you explain how the report links to Davos briefly?
Well, yes. And in fact, what you'll find when Davos at the end of this month takes place is virtually all the critical issues identified here are actually part of the some 200 public sessions we'll be having, many of which will be web streamed, because the whole approach we're trying to do is to identify the risks here, to have the identification go to insight at Davos, and then hopefully over time impact in terms of what people take away. So this is a first step in the critical cycle of our engagement on these issues. So thank you very much, everybody, and I'd like to also thank Shauna Tambogi and her risk team for the great job they've played with our partners here in putting this report together. Thank you so much. Bye-bye.
Cheers. And you can do one-on-ones just behind there when you're ready.
Okay. Thanks.